We start now with some breaking news in regards to Trump's newly appointed tariff. The US has officially started collecting that baseline tariff of 10% from countries like the UK, Saudi Arabia and Australia, causing a $5 trillion loss in S&P 500 value. That is breaking coming in there. We now move on. US Federal Reserve Chair Jerome Powell says President Trump's new tariffs are larger than expected and the economic damage could be too. Speaking in Virginia, Powell warned of a highly uncertain outlook with elevated risks of both inflation and unemployment. The FED now faces a tough balancing act as the tariffs threaten its dual mandate of price stability and maximum employment. This is what he said.
Turning to monetary policy, we face a highly uncertain outlook with elevated risks of both higher unemployment and higher inflation. The new administration is in the process of implementing substantial policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. Our monetary policy stance is well positioned to deal with the risks and uncertainties we face as we gain a better understanding of the policy changes and their likely effects on the economy. While uncertainty remains elevated, it is now becoming clear that tariff increases will be significantly larger than expected. And the same is likely to be true of the economic effects, which will include higher inflation and slower growth. The size and duration of these effects remains uncertain. While tariffs are highly likely to generate at least a temporary rise in inflation, it's also possible that the effects could be more persistent.
While markets have reacted sharply, Powell held off on committing to any immediate policy moves. He emphasized that the FED's priority is to keep long-term inflation expectations stable, even if prices spike in the short term. Despite pressure from President Trump to cut rates, Powell said more data is needed before acting, cautioning that the impact of these tariffs could be more persistent than many had predicted. The chair said the following.
We'll continue to carefully monitor the incoming data, the evolving outlook, and the balance of risks. We're well positioned to wait for greater clarity before considering any adjustments to our policy stance. It is too soon to say what will be the appropriate path for monetary policy.
We are joined by Dr. Jayjit Bhattacharya, President of the CDEPR, to discuss this further. Thank you very much for joining us. I first of all wanted to start with this news coming in that these 10% baseline tariffs have now been imposed in countries like the UK, like Saudi Arabia and like Australia. This is obviously, this whole commotion has led to the global stock market to plunge. What can you tell us a bit more on the economic front about this whole crashing of these markets?
You know, it's inexplicable that these baseline tariffs have been put on the economies that you just mentioned, because US actually has excess imports, a positive trade deficit with these countries, with UK, with Australia, with UAE, and so on. So US is actually exporting more to these economies than it's importing. So what is really the rationale behind these tariffs becomes a question mark, especially because the tariffs are being calculated not on the basis of tariffs per se, but on the basis of the trade deficit divided by the total imports coming in. So it's a strange number that has been put together to compute the tariffs. And because the whole process is not clear, it's not really explainable, there is a lot of uncertainty in the market. And there doesn't seem to be light at the end of the tunnel. So April 2nd was not the last day on which the US announced its tariffs. So it seems to be a continued process of uncertainty with tariffs and counter tariffs being put in, and therefore counter to counter tariffs are going to come in. And hence, under such uncertainties, investors would like to withdraw their money and sit on the cash rather than keep that money in the stocks. And therefore, you see a absolute mayhem in the stock markets. If you look at the US stock market, it has gone down by an equivalent of 10% of the US GDP. And that's something similar we are seeing in many of the other countries. Now, again, unfortunately, stock markets kind of reflect in which direction the economy is going. So clearly, if the stock market is any indicator, the US economy might be going downwards at a pace that than is being predicted elsewhere.
Yes.
So these are, the immediate concerns that's bedeviling the stock markets in US and in the rest of the world.
Dr. Bhattacharya, there's this phrase that's obviously being bandied about and being used by experts and people in power. That is trade war. What is that exactly? And we've also seen obviously this $5 trillion loss in S&P 500 value. Can you explain a bit about that for us?
Actually, most wars are fought because of economic reasons, because of underlying economic reasons. So all war leads to an economic benefit, and which includes the kinetic warfare. Now, coming back to trade, that's as basic as it can get, because the whole objective is to gain disproportionate economic benefit in the interactions with other economies. The tariffs are being used as a weaponization for the trade war. Trade war being essentially trying to get an upper hand in terms of the trade that's going on, and therefore benefit your own domestic economy at the cost of other economies. So we are back to that old zero-sum game that if you gain, I lose, and therefore I need to gain for you to lose, which need not necessarily be true, but that's the way that the tariffs are being used in a zero-sum game.
Dr. Bhattacharya, obviously the US Federal Reserve Chair has said that these tariffs are larger than expected, and the economic damage could be larger too. What is the role of the Federal Reserve Chair in this whole matter?
Well, largely in this context, the Federal Reserve Chair needs to make sure that there is no inflation in the US. And the concerns that are coming in is because of higher than expected tariffs, there'll be a higher than expected impact on domestic demand, and therefore a higher than expected impact on the monetary policies or the way the dollar will be moving in the US. It lead to job losses and therefore reduce demand. And on the other hand, in order to push for more investments, the US administration is pressurizing the Fed to actually reduce the interest rates. Now, if you reduce the interest rates, there will be an inflationary impact.
Yes.
And will it really lead to an increase in demand is a big question mark.
Dr. Bhattacharya, thank you very much for joining us.